When you first start dividend investing, you might be looking at dividend yields and thinking that the higher the number, the better your returns will be. Now, that is partly true. A high yield can mean more money in your pocket in the form of dividend payments, but there's more to it than just chasing the highest number. When you reach too high for yields, you might end up with a portfolio of dividend traps, and that will not end well. But on the other hand, if you play it too safe with low yields, you could be adding years to your goal of hitting your ideal income amount. It's the sweet spot that offers good returns without the daily fear of your investment falling apart. In this video, we'll look at what the ideal dividend yield is. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Before we find that ideal yield, let's make sure we're all on the same page here. A quick definition of dividend yield. Alright, let's break down what dividend actually is. When you own a piece of a company, they share some of their profits with you. Those are dividends. Now, dividend yield is a way to see how much money you'll be getting back in dividends for every dollar you've invested in that company. Basically, it's a calculation that shows how much a company pays out in dividends each year compared to its stock price. It's pretty useful because it tells you the return you're getting just from dividends without thinking about any changes in the stock price. Dividend yield determines how much in a percentage form based on the current price that you'll receive when the payment date comes. If you're using Trading 212, like I imagine the majority of the viewers here will be at this point, then you can find the dividend yield for a stock here on each page. Here's the screenshot of a popular UK-based stock, Lloyds Banking Group. And if you look down there on the bottom left-hand side, you can see the dividend yield is 5.09%. This means that if you invest £100 into this stock, it will pay you roughly £5.09 over the course of a year. If we look at another stock on Trading 212, AAPL or Apple, Apple is probably the most popular stock on Trading 212 at the moment, or at least the most held. And looking at the same place, we can see that its dividend yield is 0.46%. Now, you probably have a Trading 212 account already, but I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or planning to open an account, then here it is, DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. How to calculate dividend yield. To figure it out, you just divide the annual dividend per share by the stock's price per share, and here's the formula. And this gives you the dividend yield as a percentage, making it super easy to compare with other investments. An example to illustrate. Let's say you're looking at a company that pays $2 a year in dividends for each share you own. If the stock price is $40, here's how you'd calculate the dividend yield. So in this example, the dividend yield is 5%. This means for every $100 you have invested in the company, you'd earn $5 a year in dividends, assuming the dividend payment stays the same. Why it matters. Dividend yield is cool because it gives you a quick idea of the income you can expect to make from your investments just from dividends. If you're someone who likes steady, reliable returns, stocks with good dividend yield might catch your eye. But you also have to think about whether those dividends are sustainable. Sometimes a super high dividend yield can be a warning sign that the company might be in trouble, and the dividend might not last. What to watch out for. Figuring out if a dividend yield is high or low isn't just about the number itself. We saw earlier that the two stocks in the example screenshots had very different dividend yields. But is 5% good? Is 0.49%? You've got to compare it to things like industry averages, the company's past yields, and the overall market. If a yield looks too high, that might seem great, but it could also mean there's something wrong, like the stock price has dropped or the dividend might be getting cut soon. So let's proceed with the dividend yields you should watch out for. Dino stocks. Dino stands for dividend in name only. These are companies that do pay dividends, but they're not really something worth writing home about, and they're not really the stocks that you buy for the income at all. What are Dino stocks? Dino stocks are companies that pay dividends at a low amount that, sure, you're receiving dividends, but it's at such a small amount, you may as well not be paid at all. If a company is paying a dividend at less than 3%, with some caveats we'll come to later, I'd describe these as dinos. Apple, as we saw earlier, is a dino. It pays a dividend, but you need such a large amount of shares of this company to build a portfolio that pays your bills. If we do take that dividend yield of 0.49% that we saw Apple was paying, you'd need to invest approximately £2,448,980 in the stock to generate the equivalent of £1,000 per month in income. That's a lot. There are lots of reasons to buy Apple stock, but building a portfolio that pays your bills is not one of them. It's a dino. Why are dino stocks risky? They aren't inherently risky as such, it's more just that it'll take you longer to reach an income goal if you invest heavily in low-yielding stocks. As I said above, they can be perfectly good companies with great business models, but they just don't pay out as much in dividends. This is only an issue if you're looking for income. Dividend traps. Dividend traps are stocks that look nice, have high yields, but they have a nasty surprise either in the form of a dividend cut or a fall in stock price. What are dividend traps? Dividend trap stocks are those that offer a dividend yield significantly above the market average. The question is, though, for how long will they continue to pay at that attractive rate? A dividend trap refers to a situation where an investor is lured into buying a stock primarily because it offers a high dividend yield, only to discover later that the stock's price declines significantly, or the dividend is unsustainable and might be cut or eliminated. Or in fact, both could happen together, and it often does. Why are higher yielding stocks risky? High yielding stocks can be pretty risky, and here's why. First off, these companies might have trouble keeping up with their dividend payments if their earnings aren't strong enough. This could lead to dividend cuts, which usually end up dragging down the stock price too. Another thing to watch out for is that a high dividend yield can sometimes be a warning sign of underlying issues with the business. If a company's stock prices drop because of poor financial health, that high yield might be a red flag. Also, many high-yielding stocks are in sectors that are sensitive to economic changes, like REITs and utilities. When the economy takes a hit, these companies might struggle to keep their dividends stable. On top of that, companies with high yields often have a lot of debt, which makes them more vulnerable, especially if interest rates go up or their revenue is unstable. And in a volatile market, high-yielding stocks can be extra shaky, as investors might flock to safer options, causing these stocks to drop in price. Ideal dividend range, 3% to 8%. So if you've been following the dividend experiment for a while, you're probably already familiar with this concept, especially if you've downloaded the free PDF guide that I made to help investors choose dividend-paying stocks. If you haven't received that, you can get your own copy delivered to your inbox from the link in the description of this very video. Over the years, I've zeroed in on what I considered to be the ideal dividend yield range. A dividend yield in the 3 to 8% range is generally where I like to be to feel comfortable about it. Let me explain why this range works so well. When you go below 3%, sure, the company might be rock solid, but the income you're getting from dividends is going to be pretty minimal, almost like something you'd consider as a bonus rather than a substantial income stream. On the flip side, if the yield starts creeping above 8%, that's when the alarm bells can start ringing. High yields can be tempting, but like we discussed earlier, they often signal underlying issues with the company, like a plummeting stock price, which can artificially inflate the yield. So in my opinion, the sweet spot is that 3 to 8% range when you're getting a decent return without taking on too much risk. Let's break this down a bit more. 3% to 4% yield. This is the lower end of the ideal range, and it's where you'll find some of the more stable blue chip companies. These are the businesses that have been around for a while, with consistent earnings and a solid commitment to paying out dividends to their shareholders. They're not the most exciting in terms of growth potential, but what they offer is reliability. If you're looking for a steady income stream without a lot of drama, this is where you might want to focus. These companies are kind of like the good long-term holds to build up the foundations of a dividend portfolio. 5 to 6%. Moving up the ladder, yields in this range start to get a bit more attractive, especially for those who are really focused on generating income. Stocks in this bracket often belong to companies that still have solid fundamentals, they're making good money, and they've got the resources to keep those dividends coming. At this level, you're starting to get a better return on your investment without venturing too far into uncomfortable, risky territory. It's a nice middle ground when you can enjoy a higher yield while still feeling pretty confident that the company can sustain it. 7 to 8% yield. Now, when you hit this range, things start to get interesting. The yields are high, which can be super appealing if you're looking for a significant income, but this is also where you need to be more cautious. Companies offering yields in this range can still be solid, but you need to do your homework. Sometimes the high yield is just a sign that the stock price has dropped significantly, and if that's the case, you need to figure out why. Is it a temporary issue that the company can recover from? Or is it a sign of deeper problems? Ideally, you want to make sure that these high dividends are backed by strong earnings and a stable financial position, and not just a fluke caused by market volatility. So why does this 3 to 8% range work so well? It's all about balance. On one hand, you're getting enough of a return to make the investment worthwhile. On the other hand, you're avoiding the pitfalls that come with chasing ultra-high yields, which often lead to disappointment when those dividends get cut or the company starts struggling financially. It's like finding that perfect middle ground where you can enjoy a steady income without losing sleep over the stability of your investments. Wrapping up. Like a lot of things, balance is the key. It's a bit concerning seeing people show off their 15% yielding portfolio without mixing up metaphors too horrendously. We all know there's no such thing as a free lunch, and we have to pay the piper at some point. On the other hand, seeing a dividend investor investing in yields of their portfolio under 1% really begs the question if they shouldn't be aiming for a different strategy completely.
If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!